Hi, it's Victor here from Trend Following Trading for Beginners. And in today's episode, I want to talk about how to manage your trades when the market is having a panic attack coming up next. Just another week starting and market already gone bananas. Basically, what we can see here is quite a lot of things as suddenly people start to taking a view of the coronavirus spreading from Asia Pacific area and into Italy. I mean, over the weekend when I did my last podcast on the weekly update, I was saying, watch out on the Apple share because it's coming down in the short term, and that sort of gauge a bit about the Dow Jones as well. But to me, I mean, at the similar time, I also said, Italy having outbreak of the coronavirus, but that seems to spook the market on Sunday night or Monday morning when the market opens in Europe and then spread over to America and around the world as well. Basically, people always have this funny mentality that this coronavirus is a Chinese thing, it's an Asia thing, and it's not going to upset other people. And unfortunately, what it looks like now, as far as we can see, is that somehow it is spreading, and it's spreading mysteriously to Italy, and we don't know what is actually carrying that disease over into Europe. But that basically spooked the world a lot more because I suppose people in Europe feel the disease are a lot closer now, and then it's no longer just a Asian problem. It's very much close to home, and that sort of panic spread, and everybody and his dogs just like jump out the window, so to speak. There's this old stock market saying that when the market is panicking, the bears jump out the window, the bulls walks up the stairs. So basically when the bear case come in now, it just goes so quick, and suddenly we have 800 or more, I think, 1,000 points drop yesterday on Monday, the 24th of February, and then today again is 25th. I think at the moment Dow Jones is down about 800 odd points or something. So in about 2 days, we have the Dow Jones gone down like almost 2,000 points, just because of this little the virus seems to have spread over. I mean, the virus, if you think of it, has been around since first reported this flu-like virus in China back in early December last year. Now only, people panicking over the West because it's spreading and it's into Italy. The most worrying thing is that we don't know how that will spread from Asia into Italy. Even though they found a businessman from Italy went to China and came back to Italy, and they initially thought that is the super carrier carrying the disease and go back into Europe, but they found the businessman and did some tests in there in Italy, and found this businessman is having a negative outcome on test of the blood and so forth, and then so people really worry how that virus actually get carried over. So that's basically more the gist of the panic. But I also feel that instead of just this panic as a cause of the virus as a cause of the panic in U.S. stock market coming down over 2 days, 2,000 points or so, I personally feel that it is all because the market is overextended in U.S. and also around the world, I believe, and mostly in America. And remember, this bull market in America has been up for I think 2008, 2009. So now you're talking about 10, 11, 12 years of bull market. And people have always been saying for the last 2-3 years now, almost every year there is going to be a bear market, because normally a bear market comes in every 7 to 8 years or so forth, and this market in US has been extended. and it's 12 years now. So basically, is from my point of view, the market has basically bubbled up far too much, and now the market just using an excuse to take some profit off the table. I mean, to think of the whole thing. I mean, the U.S. market is almost 30,000 points, and we come down to see 2,000. It was like not even 10% yet, so 78% correction. That's what I call it at the moment. But it's not fun when you actually live through this kind of ups and downs, suddenly just drop, and there's nothing much you can do about it. And especially when you have pension, and suddenly you don't see the statement yet, but those people who have pension will probably feel it in the next pension updates, statement updates, and see the 401k or pension plan or whatever in whichever country you're in. You see suddenly your pension you've gone down a bit because of this attack. And for me personally, been trading on the market, sort of on the sideline, just watching and see how things are actually doing. And it's not too basically I have been going through a couple of attacks like that before, when the market just gone bananas, and how to deal with things like this. It was quite difficult at the start when I first started, but I just want to share how I get around this. I'm still having the emotional ups and downs, jittery, just like everybody else, but over time, because I've seen 2003 SARS virus gone down, so it's the 2008 market crash because of the subprime market. I just feel that I basically have gone through those two big hiccups in the market. I'm able to I come with some strategy to help myself, and I hope to share that with you today. First one is, I think the best one is always to think long term, which I've said it before. Trading is not really just for a day or two kind of things. It's a long-term thing. You need to have that mindset to think about it. So you're like, I'm almost 50 now, so when I'm like 80 or 90, I will still be trading, and that's my mindset. So ups and downs are inevitable. Markets to go up and down, whatever you likes. There are gaps. So like Apple comes out with some news, and it's not what the market wants already priced in. Well, and then the market just goes straight down, gap down. And what you do about it when you are buying Apple and you're long on Apple, and then the result comes out, which is in line with market expectation, and boom, goes straight down. So it's no different between when the markets go panic and everything just jumped down a notch, so to speak. So those are the things that you need to take into account. So if you want to trade, you want to make money in the market, you basically just have to live with it. It happens. So, but however, we can reduce the damage by basically reducing your trading size, which I talked about before in my previous podcast, where I called it the heat of your portfolio. You need to have this carefree state, which Mark Douglas talked about, which I also did a podcast on that. And basically, you need to trade enough size that make some gain, reasonable gain when the markets go in your favor, but not so much that when the market go against you, you really panic, really get emotional about it, and hurt your account. So I will always say, especially a new trader, don't try to think get rich quick and basically trade accordingly. Trade smaller size you can until you can emotionally control it. And even then, when markets suddenly gap up or down against you, against what your initial thinking, you need to basically take on this drive, so to speak, and basically move on. But the other thing can also help you is having a trading stop loss. Now I have two minds on that. Trading stop loss, I don't leave in the market, because I believe people or the market maker somehow know about it, where you put a stop loss, and then they try to do what they call a stop loss hunting, and then basically go and move the trade, or share price, whatever, to just basically touch your stop loss, and then go the other way around. So I don't leave leave the what you call a trading stop loss in the market. But if you do leave in the market, it does also help as well. So I mean, it's you need to do that yourself and test it out yourself, see if you're happy with it. For me, I basically, if I see there's a gap, I just take it, I just leave it. I know it hurts. I just basically go to the market the next day and just close out. Okay, that's what I do. I have suffered a lot of gaps before, but also I have emotional, issue with the gaps. And I say, what the heck is happening? Why the market is doing this to me? I thought the market is against me, and I thought, after sitting down and think through it, it just the business. This is how it is. This is what I decide to trade. Gaps is inevitable. If it happens against me and it's large gap, fine. I just take it on a stride because I'm thinking long term. I know I can make back the money a bit later on, and I don't get too hung up about it. That which basically lead to the next thing is your mindset. You really need to, with just the trading side, help you to keep your mind in control, mindset in control, your emotion in control. Okay, and you also have to stay calm. And especially in up and down market like this, there's no point blaming the market. Remember, you put on the trade, whatever system you're using, either you buy from somebody else or your own research, whatever you constructed it, you follow it to the T. But the market is always going to do its things. Remember, it's probabilities. The market might totally go against you and go the other way around. But in this instant, the market is in panic mode, it just jump. Big time, gap jump, and way close away from your stop loss, and you have a huge or much bigger loss than you initially anticipated. But basically, that's the part of doing business. You do find that you will have some losses, quite a lot, especially trend following, and you want to keep your losses small. But however, sometimes big losses can still happen with the gaps that happens, like yesterday and today, in Dow Jones, for example. That's just inevitable. Nothing much you can do about it. And basically, the next thing is when the market actually gone down like this, follow the market, follow your system. Your system say get out, you get out. Don't try to do it the other way around to try to catch a falling knife. To basically say, okay, the market gone down a lot. There's some that can't bounce, just a little rebound. I go catch that. But what happened if the market, today is the second day that the Dow Jones moved another 800 points down. Okay, yesterday is 1,000 points, 800 points today. If nothing to stop the market go another 500 or 200 points, 300 points down tomorrow, and you go to try to buy today, catch a falling knife, or let's say Apple, you think it's falling down enough, or Amazon or Alibaba, whatever, and then tomorrow the market continue go down because the virus spread or suddenly it happens in America, people panic, boom, you can go down another 1,000 points, and you try to catch a falling knife, you go to hurt your account even more. So don't do that. So if the market is, suddenly gap down, and your system say get out, you get out. Or you can do the other things that you can also use this as a indicator to basically go reverse, basically go short. If you have that experience, just go short the market because your trade basically said, okay, you're long in the market initially. There's a gap down, and you can either stand aside, close your trade and stand aside, or basically go short as well. A lot of professional trader basically, and they see there's a large movement, go reverse suddenly, and basically just jump into the market and just go reverse. So initially they buy, they face the gap, they get out of the trade because the system say get out, and they basically reverse the trading decision. From initial buy, they go to and short now, and continue to short the market until the market tell them the other way around. A lot of people just freeze. A lot of people don't even do anything. The market gap down, they what they call sunk cost. Okay, basically they lost so much or quite a bit of money that out of the initial plan, the ego is also on the table, and people just don't want to get out because they lost so much or the money is in the market. They want to get it back. They want to wait until the price comes back and break even, so to speak. But those are the things that you don't want to do. You should just say, okay, I have make a decision. Basically, the system say get out, I get out. And irrespective of what the market actually is doing, This is because you want your follow your system. It's based on rules. So don't worry about the sunk costs, because over time you're going to make them back. The best thing to do is cut your losses short as quickly as you can without emotion. Remember, we're doing business here. We're trading as a business. We're trading for our future. We're not going to muck around here. So when the system actually said get out, you get out. Forget about whatever you could have or should have made. Just get out according to what your system said. That is the best strategy for me anyway. That's what I think. And the next things basically is also case in point. The market go reverse, go that way around. The things that you need to learn is trend following. Trading is trading trend. The trend is not always going to be positive trend. Always not going to up forever. It can also go down as well, and it can go down very, very quickly. So what you should do is learn how to trade when the market is down. Either through shorting the share or stock or index, whatever it is, through spread betting, CDS, whatever, or the other things. If you are limited within your country by law, you're not allowed to do that. Then think about options. Okay, trade options when the market's going down. You can short the market. Basically by puts. That kind of thing, which is possible. But you need to start thinking about how can I benefit from a down market as well as benefit when the market is going up. Okay, because trend following, if you only trade the upside without the downside, effectively you're walking around with only one usable arm. Trend following have both, trends, try to catch trend when it's going up, the trend's going up, as well as catch a trend, the trend is going down. Okay, so like last couple of days, yesterday and today, when the markets go down, if you have the correct mindset, like today, last night, because of the big gap, my system basically say, okay, get out. Basically get out. But on the short ATL system, it say reverse, basically, go short. So I gone short this morning, and cut some got a bit of money from the Dow Jones going down. But I didn't know it gone down another 800 points. I don't know. So therefore, I'm just following system. Tomorrow may totally reverse. I don't know, but I'm just following my system, and that you only get to do that. When you train your mind to actually say, okay, system say go do A, you go follow and do A. You don't go to say, okay, system say go do A, and you go do B. That's not right. Then you basically have to think that way. Okay, so trend for, remember, it try to cut trend both up and down. And the other things that you can also got to learn is, okay, when the market is down here, okay, there's also some other market that's probably up. Like in this case in point, the general market has gone down, crude oil gone down, but two things gone up. And gold, which I've been talking about quite a lot, is basically shot up and then come back down again. But the other thing is the bond market. There's the bond market just continue because people's panicking, and they go into safe haven, basically buy U.S. Treasury bond, and basically go into the bond market and the bond continue gone up. Prices basically gone up, sky high again. Basically, then therefore the yield is gone down, and that's what you hear a lot of the news on whatever the YouTube, whatever media you listen to, and say, okay, the bond market yield's gone down, those kind of stuff. That's exactly what's happening. When it's panicking, people go in those markets. So if you are open to trade, the bond market, it's actually the best of time when the market gone down, that kind of thing. That also talks about the spread of your portfolio. Don't just always just share. There's also index. Let's say the index is down, share is down, crude oil is down. If you have gold, well, gold's gone up. Then you can basically help to increase your gold, basically what go help to reduce the losses, so to speak, and then gold continue to go up, and you just stay there. Secondly, if you have also follow bond, the bond market gone through the roof, and you can basically capture some of that. So you might basically trend following. You don't just look at one or two little stocks. You have a spread of stock that's similar to my sample trading a portfolio. Even though it doesn't have bond, but you do have trade bond as well. That the losses that you sustain on the Dow Jones on index and crude oil, you get you get your money back, so to speak, from another market, in this case, bond market. So start to think about that as well. And this is why you need to think more carefully about what is in your portfolio. The list of shares or bonds or forex, are they giving you enough coverage, kind of thing. And last but not least is think of this as a good time to think of the market during this panic, to say people keep on saying market is efficient. Market is not efficient. Okay, the coronavirus has been around. When people only start in Western Europe only start panicking, when the virus spread to Italy. Okay, and also now people talking about possibility or maybe a cancellation of Olympic in Japan because of the virus is spreading over there, and they not manage stop it, so to speak. So there's all sort of things, and not just supply chain in China now. It's also supply chain in other Asian countries. Now they're also talking about what about the middle supply chains, people shipping things into Europe and America, that kind of stuff. So this is the end of my podcast for this week, and I hope you like it, and speak to you soon. Bye for now.